Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I've been rushing like crazy to get through the information for you because I wanted you to get to this is the meat of it. Now, we're going to slow it down a little bit so I can get into what's really important for you to understand about now building your portfolio. This is the where the rubber meets the road, so to speak, okay? Again, I'm going to put out there for the first 10 callers to my office, 615-376-5325. If you'd like a personalized investment analysis of your portfolio, as well as a comprehensive plan showing you basically what your financial future is going to look like based on the things you're doing today, okay? If you've got questions, if you're either already retired or you're thinking about retirement, close to retirement, maybe it's coming up next month, maybe it came up a few months ago, maybe you've been retired for years. All this will be of value to you. The comprehensive plan, I look at where you're at today, I get into show you what the risk is in what you're doing today, and then also show you what that would look like for you 5, 10, 15 years down the road. We add in for inflation, taxes. We talk about how Social Security plays into it. If you've got a pension, if you've got cost of living increases that are built into that. We go into a great amount of detail. What you have for income, what you have for expenses, what your assets are, what your liabilities are, all of that to give you a very accurate picture of your financial future. Our goal is we want to determine what is the needed rate of return on your investments to accomplish your goals. And what that first goal, of course, is to attain and maintain your standard of living and your quality of life. We all want at least that. Then we may want to add in some other goals that we might have. Maybe it's, college, help out our grandkids with college. Maybe it's about helping our kids in some way. Maybe it's about having some fun. Maybe we want to take them on a special trip, or maybe we just want to travel ourselves and do some things that we enjoy. Whatever it is, all right, that's part of the planning process and determining the practicality and reality of these things, how to accomplish them, and what risk goes along with that, as well as, again, that needed rate of return is the key component. It's through that, once we've determined what the needed rate of return is, then we can put together an investment plan, okay? And that investment plan is going to be different from each person depending on what their income needs are, how soon they're going to need that income, to what degree they're going to need it, and all the other factors that I mentioned. Okay. So that's what we're offering up for the first 10 callers. You get all of that with the investment analysis. So again, first 10 callers, 615-376-5325. Debbie's standing by. She'll get your information. She'll send you a checklist of things to bring to your appointment with me for me to be able to do this work for you, all at no charge. And I'll even include a copy of my book, 7 Steps to Financial Freedom in Retirement. Basically that book outlines what I've been doing for the last 26, 27 years now. Okay? All right, let's look at the next slide, Dow Bar Investment. I'm going to jump right back in here. I want to get this part out for you. Understanding Dow Bar is an independent research group that basically their research is based on on how investors do in the market. So in that diversified portfolio, one of the things to look at first off is how does the average investor actually do? Based on Dow Bar, they put out each year a study where they give us these numbers so we can see about an actual investor behavior in determining. Now this is from 1986 through 2015. And here you can see when you look at the average investor over that period of time, the average equity investor, stock investor, got an average return of 3.66%. Right? Now think of that. There's that active management thing coming in, isn't it? They only got 3.66 compared to the S&P. If they'd have just bought the S&P 500 index, just that one fund, they'd have been better off. They'd have got 3 times the return. That's huge when you think of how much your money would have grown over that period. And yet look at the risk. The standard deviation, their standard deviation is actually a little higher than the S&P, and yet they're not getting paid for the risk that they're taking. All right, this is why understanding asset allocation and these principles, this academic research that's available to us in the science of investing is so important. So why are these returns so low? Average holding periods, less than 3.5 years. Track record investing, they were always chasing the next hottest thing. Active stock picking, again, active management, market timing, getting in and out of the market. These are all things that when we look back and they try and determine why did the average investor do so poorly compared to the market, these are the reasons why. So if we don't want to be that person, right? We want to do better now that we're going to understand how this works. So let's look how you create, in fact, a diversified portfolio based on passively passive investments, okay? So now a basic passively invested portfolio. So step one, the S&P 500. So if we've just bought the index fund, and I got to tell you, if you're in your 20s out there and you're hearing this, or if you've got kids in that age group and you want to share this with them, if they're first starting out and they're not sure how to invest and they just have a little bit of money, if nothing else, an S&P 500 index would be a great fund, would be a great way to start. Very low cost. Vanguard's a great resource for that. Then as they build up, I'll show you how you can add on to that portfolio. But if nothing else, if you're just starting out and you got maybe $50 or $100 a month or whatever it might be, 25 bucks a month, even whatever, that you can put in something and you want to save, there's the way to start. S&P 500 index fund. Again, from 1970 through 2015, over the last 45 years, average return about 10.25, standard deviation 17.3. If you're in your 20s, you can deal with all that volatility. Now, as you get up into your 50, 60 range, you're getting closer to retirement, we got to reduce that volatility down. In particular, where it's critically important is when you get to the point where you're going to start taking income from your portfolio, then we really have to be careful when it comes to volatility, or as you near even that point, because that's where it can backfire. And if you don't reduce that volatility, it could cause you to run out of money much earlier. All right, let's look at, or earlier in your life. The plans that I put together for my clients, when we're done, we're going to make sure that they're not going to run out of money at all, that they're going to have the money they need to maintain their standard of living and quality of life at a bare minimum that. All right, next, we're going to add in 5-year government bonds and 1-year fixed income to our portfolio. What did we accomplish? Look at the comparison. We dropped our return a little bit, right, about a little less than 1.25%, but we dropped our standard deviation or volatility down dramatically by over approximately 7%. That's step one. Now let's look at the next. We're going to go to adding some more asset classes in. Let's look at now adding Euro, Asia, Far East, as well as international small companies into the mix. So on that next portfolio slide, creating that diversified portfolio, we should have, do we have it up there? There we go. All right, so now what kind of return when we add those two asset classes in, asset categories in as well? Now look what happened. Our return increased to 9.78, so we got about a 66 basis point jump, okay, almost 2/3%, but our standard deviation or volatility only went up about 47 basis points, or less than half. So we're getting a little bit of nuance here. Let's go to the next slide, creating that diversified portfolio. Now we're going to add in small cap value, large cap value, and look what happened here in the building of this portfolio. And these pieces, by the way, this is developed from Dr. Fama's research, right? The 3-factor model. He won a Nobel Prize for that. Here's where now we put in, and notice how the percentages work on this, okay? So now on portfolio 4, we've increased our return ahead of what the S&P was making, and yet we've been able to keep the standard deviation about 2/3 of what the S&P was. So we've reduced risk, increased return. Now we're getting a bigger reward relative to the risk that we're taking in that volatility. All right. Next part is creating a free market fund portfolio. I'm going to skip that one and go right to creating a well-diversified portfolio. This is the one, all right? The well-diversified portfolio, what we're looking at is Dr. Fama's research. Now, this particular one is a 60-40 asset allocation, okay? That means 60% is in stocks, 40% is in fixed. This hypothetical portfolio put together, again, based on Dr. Fama's research. And you notice now how we get into real nuances, because what he did was he kept back testing. He would try different asset categories, blending different ones together to try to figure out what's going to give you that sweet spot of the best return with the least amount of volatility. All right, what asset categories, are going to be used first? And he determined, as we talked about with the 3-factor model, stocks and bonds, large and small companies, and then growth and value companies, and with that, of course, domestic and international, so that it's a global portfolio. Over 15,000, 16,000 unique holdings. Again, extremely well diversified. And the percentages are minute in some instances. International large, for instance, at 1.3%. And this portfolio design is similar to what is what we base the portfolios that I use in my practice on. Okay. We can get rid of the slides, and let me bring this down for you to understand. When you're putting together that portfolio, okay, this is where you can utilize a number of different ways to accomplish that goal. What we're seeking is to hit that model portfolio based on Dr. Fama's research, and there are some ways that we've even been able to improve upon that. And you can do these same things if you understand how this research works. Again, I covered in my book, 7 Steps to Financial Freedom in Retirement, How the Smart Money Invests. I get into modern portfolio theory and the 3-factor model and talk about how those things can be utilized in a portfolio. For clients that come in to see me, for my clients, and both new and old, this is one of the things when we're looking at ways that we can improve our success rate, if you will, to not run out of money during our lifetime, that we can be able to maintain our standard of living and quality of life. That's where we start. Then from there we say, now can we add in some fund money? What does it look like? Year in, year out, I can show you how your money will grow, or I can also show you, if you're doing the wrong things, whether or not you're going to run out of money. And we look at where you're at today, and we say, okay, here's where that's going to take you 5, 10, 15 years if you keep doing those same things. And then we're going to show you ways to improve upon it, which is what I'm doing for you today. Hopefully this is helpful in that regard. We're going to take another break. When we come back, I'm going to delve into some things here about this portfolio design. And again, I'll give them one more time. I'll give an offer out there to assist you in putting together your portfolio, all right, utilizing these principles. So join us here. We'll be right back on the Retirement Report.